We are going to talk about why stocks outperform real estate. Why is it that people should not invest in real estate but stocks? Is there a reason? And how do we justify this decision? Now, let me talk about certain practical aspects of buying stocks versus real estate. Now, stocks win because of the opportunity. There are thousands of tradable ideas to better diversify your portfolio, make it more liquid, and leverage the time. There are thousands of US and global stocks which have limited and unlimited potential to grow as compared to the local real estate deals. So, stocks provide you international opportunity, whereas real estate gives you local exposure. Also, liquidity and time leverage is very important aspect. Stocks you can buy and sell anytime, any day. You can scale positions without any problem. You want to buy more stocks, you can increase the number, you can decrease the number, but that is not the case with the property. Also, you can better diversify your portfolio with different types of stocks. However, you may not be able to diversify your real estate portfolio with 20 to 30 properties because that would be more than what you can ever imagine. Also, you can target a return on capital employed, which is greater than 15%. You can have low debt and can invest in some of the best companies available in the market. You need to adopt a systematically scan the broad universe of stocks to raise the performance or to gain the performance of the stock. Now, one of the most important and critical aspect of buying a real estate as compared to stock is the speed and the friction. Real estate normally has high friction. There are different types of owners once you deal in a real estate. The owner, the property dealer, the buyer, the seller, the bank, the lawyer. So there are multiple stakeholders. Once you get into a real estate deal, it can go from months to years with different types of negotiations. Also, there are a lot of emotions attached to property and a lot of complexity and delays are also there. It's a slow, stressful process which reduces the time leverage. You spend a lot of time in taking a decision to buy a real estate. However, stocks, on the other hand, have zero friction. You can buy and sell stocks in seconds with 100% reliability. You do not have a post agreement negotiation going with the stock dealers. You just on the spot within seconds buy stocks which you like. Stocks are highly liquid and scalable. You can buy equities and ETFs, and whenever you want, you can sell them as well in case of need. Also, it favors your time and gives you the power to execute any of the transactions anytime. So you need to find out whether real estate fits your personality. You need to pick investments that match your temperament. So if you as a person enjoy negotiation, get into multi-party deals, and you have the knack of problem solving, as well as you have a lot of money to invest in, you can probably think about the real estate. However, if you do not have any of these and you want to still make wealth, you have the options to get into stocks and mutual funds. This is something which is as easy as it can be. As we have already discussed, stocks can deploy billions within a minute. It can enable rapid compounding in fast scaling. If you leave your stocks for 10 to 20 years, real estate is illiquid. You cannot go and buy your property or sell your property the next day. If you want to sell your property, you probably won't get the deal which you are expecting. For most investors, having a balanced portfolio wherein there is 70% equities, 20% bonds, and 10% real estate. You can use stocks for sale and liquidity. Also, if you want to buy a home, it should go for your own personal usage. So this is something which you as an investor, as a customer, need to understand and choose which is the better option. liquidity, ease of doing transaction, scalability, and the amount of wealth you can make through compounding is unlimited through stocks. So this is something which is not very difficult to understand. I'm sure all of you must have already understood how to go and understand things in a better manner. If you want to bring and start your growth engine through stocks, you can allocate 60 to 80% in equities, 10 to 20% in debt, and less than 10% unless you are an expert. You have three-layer investment process, automatic monthly SIPs, opportunistic buy on downturns, and avoiding stressful illiquid assets. So this is how you can transform your journey of making wealth in the long term by focusing more towards stocks and less towards